Your minimum payment is due in 3 days. You will pay it. The balance will drop by $11. Next month, you will do it again. And for the next 28 years. I know that number because I calculated it. For the average American carrying $6,194 in credit card debt at 24% APR, the bank's own math shows a payoff timeline of 28 years and $14,300 in interest on a debt that started at $6,000. You did not miss that number by accident. The disclosure was engineered to be missed. 6 months ago, I was going through estate documents from Holmes County, Ohio. Inside was a ledger, water-stained cover, entries in faded German script, dated 1871 through 1903. It belonged to a man named Ezekiel. On page 34, I found a grid so simple it took me a full minute to understand why it worked. No credit, no minimum payment, no revolving balance, ever. For over 200 years, through every depression and inflationary wave that destroyed the families around them, the Amish operated on a financial architecture so structurally sound that the modern credit industry would cease to be profitable if it became mainstream. Stay until the end, because the last thing I am going to show you is a calculation from the 1891 section of that ledger, one specific number underlined twice, that explains precisely why your minimum payment is structured the exact way it is, and why the people who designed it understood Ezekiel's math better than you were ever allowed to. The minimum payment is not a courtesy the bank extends to you during hard times. It is an engineered mechanism designed in a boardroom, optimized over 5 decades to extract the maximum possible interest before you ever reduce a single dollar of principal. The people who built it knew exactly what they were building. Before 1970, most credit cards required full monthly repayment. The balance was due, all of it. Then the industry lobbied. By the mid-1970s, revolving credit became the standard. The Federal Reserve's 2011 Consumer Finance Study documented what happened next. Once minimum payments became the psychological anchor on billing statements, the average repayment rate dropped by 40%. Consumers who previously paid in full began paying only the minimum, not because they couldn't afford more, but because the number on the statement told them that was enough. Behavioral economists call this anchoring bias. The bank places a number in front of you. Your brain accepts it as the reference point. The interest meter runs. That is not an accident. That is architecture. You were not careless. You were targeted. Rule 1. The envelope knows what the algorithm hides. When I first opened Ezekiel's ledger, I was looking for something else entirely. I found it on page 34. A hand-drawn grid. 7 columns, each labelled in faded German script. House, food, clothing, tools, children, community, reserve. Next to each column, a penciled number, a fixed allocation, and at the bottom of the page, one rule written in larger letters than everything else. Kein Geld, das nicht schon existiert, kann ausgegeben werden. No money that does not already exist can be spent. That is the entire system. That is what the credit card industry has spent 50 years working to make you forget. The Amish envelope method, what modern personal finance researchers now call zero-based budgeting, operates on one foundational principle. Every dollar is assigned a destination before it is spent, not after, before. Physical envelopes, labelled, filled on payday. When the envelope is empty, the category is closed. No. Revolving balance. No exceptions. The minimum payment mechanism only works if you spend money you do not have. The gap between consumption and payment is where interest lives. The envelope system eliminates that gap at the source, not through discipline, through architecture. Researchers at the University of Maryland published a study in 2019 showing participants using physical cash envelopes spent an average of 23% less in discretionary categories, even when total available funds were identical. The physical act of handling cash activated loss aversion in ways that digital transactions never do. The Amish have been leveraging that neurological reality for 200 years. They observed it in practice, generation after generation, and wrote it into the ledger. Rule 2, the zero principle. There is a second entry in Ezekiel's records that stopped me cold. The 1887 section. A notation about a neighbour, referred to only as der Nachbar, who had borrowed from a Lancaster County merchant. The entry does not moralise. It records the arithmetic. The neighbour borrowed $40 at 8% annual interest in January of 1887. By December of 1892, 5 years later, the outstanding balance had grown to $58. The man had been making partial payments the entire time. He had paid nearly $30 into the debt, and he owed more than when he started. Ezekiel wrote one line beneath this calculation: Die Schuld ernährt sich selbst. The debt feeds itself. That observation, recorded in pencil in rural Ohio in 1887, describes with perfect precision what modern economists call the debt spiral. Here is the modern version. You carry $8,000 on a card at 22% APR. Your minimum payment is $160. In month 1, $147 goes to interest. $13 reduces principal, balance after payment, $7,987. Month 2, the same calculation restarts on the new balance. Month 3, the same. The Consumer Financial Protection Bureau's own modelling shows the payoff timeline on this. Scenario exceeds 30 years. Total interest paid, over $20,000. On an $8,000 debt that has not grown by a single new purchase. Die Schuld ernährt sich selbst. The Amish zero principle is about refusing to participate in a mathematical structure designed to never resolve in your favour. The lender controls the interest rate, the minimum payment formula, the penalty structure. The borrower controls one thing only: the decision to enter the arrangement. The Amish decision is made at that first moment. The answer is no. Structurally, permanently, no. You have already heard the argument. From financial advisors, debt management programs, well-meaning relatives. You just need more willpower. That framing is not an accident. When the problem is defined as personal failure, the solution becomes personal reformation. You download a budgeting app, you cut up one card, and the system continues operating exactly as designed because the structural mechanism was never addressed. Cornell's Behavioral Economics Department published research in 2015 documenting the self-blame trap in consumer debt psychology. Borrowers who attributed their debt to personal failure were significantly less likely to alter the structural conditions of their borrowing. They kept the cards open, kept paying interest, accepted the arrangement as a consequence of their own inadequacy. The industry benefits directly from that shame. Ezekiel's ledger contains no entry about willpower. It contains columns, fixed allocations, physical envelopes, and a mathematical principle that fits on one line. The Amish did not solve a discipline problem. They built a structural system that made the discipline question irrelevant. We are halfway through what I found in that ledger. The two rules I have shown you are the foundation. Documented, mathematically verifiable, they work. But there is a third entry near the back of the 1891 section. A calculation I have never seen referenced in any personal finance guide, any debt management curriculum, or any bank disclosure document. It explains why the credit card industry structured their product the exact way they did, and why changing one specific behaviour collapses the profitability of your account from the bank's perspective almost immediately. That entry is coming. Stay with me. Rule 3. The deliberate delay. A section of Ezekiel's ledger is labelled Kaufentscheidungen, purchasing decisions. It contains a rule that reads as incomprehensible to a culture built on one-click checkout. No non-essential purchase is made within 30 days of the desire arising. Not 24 hours, not a week, 30 days. Ezekiel's reasoning in 3 lines. The need passes on its own. It was an impulse. No money spent. The need persists. It is genuine, funded from the appropriate envelope. Or the community provides a solution. No individual expenditure required. The credit card industry's entire impulse purchase revenue model depends on eliminating that 30-day window. Contactless payment, one-click purchasing, buy now, pay later. Every structural innovation over the past 20 years has compressed that window to 30 seconds. The Federal Reserve's 2022 Consumer Payment Study found 42% of credit card transactions are impulse purchases. At 24% APR, the interest revenue on those unplanned transactions exceeds $60 billion annually across the US consumer base. $60 billion generated by eliminating the pause. Ezekiel's rule requires one structural commitment made in advance. The pause is built into the system. The impulse hits the rule before it hits the wallet. Near the back of the ledger, in the 1891 section, Ezekiel made a calculation with no label above it. A column of numbers and a final figure underlined twice. He calculated the total interest cost of a $100 debt at 8% annual interest, the prevailing merchant credit rate in Lancaster County, under 3 repayment scenarios. Scenario 1, full repayment at end of month 1. Total interest cost, 67 cents. Scenario 2, repayment over 12 months in equal installments. Total interest cost, $4.33. Scenario 3, minimum partial payments at 2% of balance monthly, which mirrors exactly the modern minimum payment formula. Total interest cost, $38.41. He underlined that last number twice and wrote one word next to it, Warum. Why? Not as a question about the math was clear, as a question about the choice. Why would any person, given those 3 numbers side by side, select the third option? The answer, in 1987, the credit card industry lobbied the Office of the Comptroller of the Currency to remove the requirement that minimum payment disclosures include total interest cost projections. Before 1987, your statement showed you the full cost. After 1987, it did not. The Credit Card Act of 2009 partially reversed this. But 2 decades of consumers deciding without complete cost information had already reshaped a generation of financial behavior. Ezekiel asked why in 1891. The industry answered in 1987. That is not incompetence. That is deliberate design. What you can do this week. Step 1. Calculate your actual number. Use the Consumer Financial Protection Bureau's free credit card repayment calculator. Government tool, no sign up. Look at the payoff date and total interest cost. Write those 2 numbers on paper and place it where you keep your cards. That is Ezekiel's Warum moment. The math made visible. Step 2, assign every dollar before the month begins. Fixed costs first, then food, then transportation, then everything else. Whatever remains is your debt acceleration fund, entirely to principal, above and beyond the minimum. Step 3, apply the deliberate delay to every non-essential purchase. 30 days. Put it on a list. If it is still necessary in 30 days, fund it from the appropriate category. Step 4, apply every dollar above minimums to your highest interest balance first. Not the smallest balance, the highest interest rate. This is the avalanche method, mathematically optimal. Every dollar you put toward the highest rate debt saves you more in future interest than the same dollar applied anywhere else. Ezekiel would recognize it immediately. It is the same logic as his 3-scenario calculation from 1891. The timeline, $6,000 at 24%, APR, with $200 per month above minimums. Payoff in approximately 28 months. Total interest roughly $2,100. The same debt under minimum payments only. 28 years, $14,300. The difference is $12,200 and one structural decision. Banks sell you credit. Financial advisors sell you courses on managing the credit the banks sold you. The debt management industry sells you consolidation loans to replace the debt the credit built. The cycle is profitable at every stage, for everyone except you. I have nothing to sell you. I have a water-stained ledger from Holmes County, Ohio, a government calculator, and arithmetic that has not changed since 1891. Ezekiel wrote this system down because he wanted the next generation to have it. Open your wallet right now. Count the number of active credit cards in it, not debit cards. Credit cards with an available revolving balance. Write that number in the comments. Just the number. Nothing else. I read every single one. And what you write tells me exactly what to find next. You now have Ezekiel's system for stopping the credit machine. The envelope architecture, the zero principle, the deliberate delay, the avalanche method. But here is the problem nobody addresses after the debt is gone. The moment your balance reaches zero, the moment you stop paying $300 a month in interest, you have $300 a month sitting in your account. And every day that money sits in a standard savings account, earning 0.5%, while inflation runs at 3 to 4% annually, you are losing purchasing power in slow motion. The credit card was extracting from you actively. Inflation extracts passively, silently, without a statement. Without a minimum payment line to make the loss visible. The system doesn't end there. In the next breakdown, Ezekiel opens the ledger on something far more dangerous, the mechanism that turns a simple home into a 30-year extraction cycle. The numbers are not estimates. They are recorded line by line across generations. And once you see how a $300,000 house becomes nearly $500,000 in payments, you cannot unsee it. What the Amish built instead removes the debt entirely, but almost no one outside their world understands how it actually works. That video is next.